Today, we are looking at a discussion that is attracting attention among Iraqi Dinar followers, particularly the idea that large holders of Iraqi Dinar could potentially negotiate lower exchange fees if the currency were ever exchanged at a significantly different rate. The comments attributed to Newshound Guru Stephen focus on a hypothetical scenario involving a one-to-one exchange rate, a large dinar balance, and a bank such as Chase charging a percentage-based fee. While this is an interesting subject, it is extremely important to separate a hypothetical calculation from a confirmed banking policy, because there is currently no verified evidence in the information provided that Chase Bank has announced a special Iraqi dinar exchange program, a one-to-one IQD rate, or a policy allowing customers to negotiate exchange fees down to zero. The basic argument is straightforward. The discussion imagines an individual holding 1 million Iraqi dinars and assumes an exchange rate of 1 Iraqi dinar for $1. Under that hypothetical rate, 1 million dinars would correspond to $1 million before any fees or other costs. The claim then considers a hypothetical 7% exchange fee. Mathematically, 7% of $1 million would be $70,000. If the fee were reduced to 5%, the cost would be $50,000. That is an important clarification because the original statement suggests that reducing the fee from 7% to 5% would bring the cost down to $20,000. That particular calculation does not add up under a one-to-one exchange assumption. A 5% fee on $1 million would be $50,000, not $20,000. This mathematical point may seem small, but it is exactly the kind of detail that matters when discussing currencies and potential exchange transactions. Financial audiences need to understand the difference between a statement, a hypothetical example, and a verified fact. A percentage fee can become extremely significant when the underlying transaction is large. That is why claims about negotiated fees deserve careful examination rather than automatic acceptance. The second part of the discussion is the idea that someone holding a very large amount of Iraqi dinar could have greater negotiating power with a financial institution. In some areas of finance, large customers can receive preferential pricing. Banks and financial institutions may negotiate certain fees depending on the size of a transaction, the customer's relationship with the institution, the type of service being provided, market conditions, and internal pricing policies. However, that does not mean every bank automatically negotiates currency exchange fees with customers, and it certainly does not establish that Iraqi dinar holders would receive 0% fees. Foreign exchange pricing can involve several different components. There may be a direct transaction fee, a commission, a spread between the institution's buying and selling prices, processing costs, correspondent bank charges, compliance expenses, or other operational costs. Therefore, when someone says an exchange fee could fall from 7% to 5%, 3%, 4%, or even 0, the first question should be, what exactly is being reduced? Is it an explicit commission, a currency spread, a processing charge, or the total cost of the transaction? Without that information, it is impossible to determine the actual financial benefit. For Iraqi dinar followers, this distinction is especially important because many discussions about the dinar focus on future exchange rate scenarios. A hypothetical one-to-one rate would represent an enormous change compared with the conventional IQD to dollar exchange rate used in Iraq's current monetary system. Such a change cannot simply be assumed because a commentator describes a potential future transaction. It would require official monetary, banking, and foreign exchange developments, along with practical implementation through financial institutions. There is also another important issue, bank acceptance. Even if an individual owns a large quantity of Iraqi dinar, that does not automatically mean a US bank will purchase it at a particular rate. Banks determine which foreign currencies they handle, under what conditions they handle them, and what prices or fees apply. Currency exchange is also subject to compliance procedures, documentation requirements, customer identification, transaction monitoring, and potentially other regulatory obligations. A large transaction could therefore involve more scrutiny, rather than simply creating an opportunity for a customer to negotiate a fee. In the short term, the most realistic takeaway from this discussion is not that Iraqi dinar holders should expect a 0% exchange fee. Instead, the useful lesson is that exchange costs matter. If a currency transaction ever becomes large enough to involve substantial dollar values, even a small difference in the effective exchange cost could have a meaningful impact on the final amount received. For example, on a hypothetical $1 million transaction, a 1 percentage point difference represents $10,000. That is significant. But the calculation only becomes relevant if the underlying exchange rate and transaction itself actually exist. This also demonstrates why investors and currency holders should be careful with social media claims about future rates. A hypothetical example can easily be repeated online until it begins to sound like an established banking policy. But a statement from a commentator is not equivalent to an announcement from the Central Bank of Iraq, the U.S. Federal Reserve, a commercial bank, the U.S. Treasury, or another authorized financial institution. Until an institution officially publishes terms, the information should remain classified as speculation or scenario analysis. Looking further ahead, if Iraq were to undertake major monetary reforms that materially changed the international treatment or exchangeability of the Iraqi dinar, the banking sector would become extremely important. A sustainable currency reform would require more than a new number on an exchange screen. It would involve confidence in the banking system, adequate liquidity, international correspondent relationships, compliance standards, monetary stability, fiscal discipline, and confidence that the new exchange rate framework could be maintained. That is where the long-term implications become more interesting. If Iraqi banks become increasingly integrated into the international financial system, and if confidence in the dinar improves, the process of exchanging IQD internationally could become more standardized and transparent. In that environment, customers might have greater access to competitive foreign exchange services. But again, that is a potential long-term development, not evidence that current holders are already entitled to special exchange arrangements. Another factor that should not be ignored is transaction size. Holding more currency does not necessarily mean having unlimited negotiating power. A financial institution could have standardized pricing, risk controls, or regulatory requirements that cannot simply be waived because a customer has a large balance. In some cases, institutional rules may be more important than the customer's bargaining position. Therefore, the idea that large dinar holders will automatically negotiate fees down to zero should be treated cautiously. For anyone following Iraqi dinar developments, the best approach is to watch official indicators rather than relying solely on predictions about future exchange rates. Pay attention to Central Bank of Iraq announcements, monetary policy decisions, banking sector reforms, official exchange rate information, international financial relationships, and changes in Iraq's broader economic fundamentals. Those factors provide a much stronger basis for analysis than hypothetical cash-out scenarios. It is also important to understand that a favorable exchange rate and a favorable transaction cost are two separate issues. Even if a currency appreciates, the final amount received by a customer depends on the actual rate offered by the institution, the spread, commissions, taxes where applicable, and other transaction costs. That is why anyone considering a major currency exchange should obtain written terms directly from the financial institution involved rather than relying on online commentary. The discussion from Stephen therefore raises an interesting question about how exchange fees might work in a hypothetical future environment, but it should not be interpreted as confirmation that Chase Bank will offer a particular IQD rate or allow customers to negotiate fees to zero. The one-to-one rate itself remains hypothetical in this context, and the fee examples should be understood as illustrations rather than established banking terms. Most importantly, the arithmetic in the original example needs to be corrected. At a hypothetical one-to-one rate, a 7% fee on $1 million is $70,000, while a 5% fee is $50,000. For IQD followers, the bigger lesson is simple. Focus on verified developments, understand the mathematics behind financial claims, and distinguish between a possible scenario and an official announcement. The Iraqi dinar story continues to depend on Iraq's monetary policy, banking reforms, economic stability, fiscal management, and integration with the international financial system. Those are the developments that ultimately determine the currency's real-world prospects. As always, we will continue following official Iraqi economic and banking developments and bring you responsible, factual analysis without presenting speculation as certainty. If you found this update useful, make sure to subscribe to Iraqi Dinar News and like the video so you can stay informed about future developments. Remember, this content is provided for informational and educational purposes only and is not financial advice. Always conduct your own research and consult a qualified financial professional before making any financial decision.